Look at this. This outlet's reporting Treasury just bought back $12.5 billion of their own debt, the largest Treasury buyback in history. $12.5 billion. Is this a accurate report? Let's find out from Dan Eastman. Dan, welcome back to the broadcast. Thanks for being with us.
Hi, Brandon. Thank you for having me on. It's always a great pleasure to be on and visit with you. Thank you so much.
We appreciate all the great financial news and information you bring us each and every day at 11:30 Central. Wait a minute now. $12.5 billion. Did our government, is this a true report? Our government bought back $12.5 billion of their own debt, the largest Treasury buyback in history. Is that a true report?
Well, if it's stamped with the Treasury seal, I would assume it is. But the Treasury buys, and what the Treasury does is it issues trillions of dollars in bonds. If you look at our federal national debt, it's $38 trillion of money that was borrowed from other people, whether it's the Japanese, the Chinese, Americans, pension funds, Social Security, whatever. And they use that money to fill the budget deficit, the gap between what they tax the taxpayers and what they spend. Last year's deficit was $2 trillion. You add that all up since 1945, and we've got $38 trillion in debt. And with the one big beautiful bill, they've expanded the debt ceiling to about $42 trillion, which is capacity. So the Treasury is constantly issuing more and more debt to fund the operations of the federal government because the tax receipts don't keep up. And that's what the Treasury does, is it sells bonds, takes the money in. But there are times when it tweaks its portfolio, and if there are bond issues that are out there at a higher interest rate, the Treasury has the ability to buy them back and effectively take dollars, buy them back, and reissue at a lower interest rate. So some of those numbers you see could be very well a refinancing at a lower interest rate. And why that's important is because when you look at the amount of tax dollars, we have 165 million taxpayers in America that pay taxes, and they raise about $5 trillion in tax money every year. But they spend $7.5 trillion. There's a big deficit. And that $38 trillion in debt has a debt service of over $1.2 trillion right now, which is about 24% of our total tax take per year. So for every tax dollar you pay in, 24% of that is going to pay interest on money they've already borrowed and spent. And it's just the big stack keeps growing and growing. So what it tells me is because the interest on the accumulated debt is $1.2+ trillion, what the Treasury is trying to do is buy back bonds that are issued at a higher interest rate and issue at a lower interest rate, which could be the market lowering the rates subtly, or it could be lowering the term on the note, on the bond or note, so that you can get a lower interest rate. So I see them as, this is sort of like patching the hole in the bottom of the ship right now when the Treasury does that. And the fact that that number is the highest in history really shows that this is a very important problem for the federal Treasury to try and reduce that $1.2 trillion debt service to a more manageable level, because our tax base is not growing. You know, our population grew with all the people coming into the country, but they're not making any money and they're not paying any income tax to speak of. So what you have is a very stagnant middle class who pays most of the taxes. And the tax base isn't growing, the tax revenues aren't growing. But the problem is you're running this $2.5 trillion annual deficit. And what they're trying to do is squeeze the cost of the borrowed money down. Now, that's $1.2 trillion that's not going into bridges or ports or airports or anything. That money is going to pay interest on the debt. And Japan is our largest foreign holder at $1 trillion. China's at about $900 billion in debt. And the British come in next at about $5 billion, about $500 billion in debt. So the point is we're paying all that money out in interest to people who hold the bonds. And, you know, when you listen to the Keynesian economists, they say, well, it doesn't matter federal national debt because we take it out of one pocket and we put it in the other pocket. But that's not true, because every single bond issued by the federal Treasury is an asset on somebody's balance sheet, and they want that money back with interest. You buy a savings bond when you go online, you buy a savings bond for your grandkid or something, that's an asset on your balance sheet. So it's not like funny money where you just pretend it doesn't matter. It matters a lot to the people who own those bonds. And that's why you see the Treasury, and that's a really spooky number at $12 billion, because what it's telling you is they're shuffling their out portfolio to lower the cost of money, because the cost of money is becoming roughly 25% of all the money they take in taxes. So effectively, if they don't do that, they're going to end up borrowing money to pay interest on the money they borrowed. And that's time when you know you're broke. That's how you know you're broke.
Well, I
okay?
did just find this at the Economic Times. Record 12.5 billion debt buyback. Treasury pulls off the largest rescue move in U.S. history. U.S. Treasury debt buyback. The U.S. Treasury executed a record 12.5 debt buyback, injecting fresh cash into the banking system. This move is reminiscent of the 2019 market conditions, could temporarily boost assets like Bitcoin. However, the large scale suggests underlying banking system stress, potentially leading to increased caution and long-term inflation that concerns that favor Bitcoin. Well, they also can favor that's definitely beneficial for gold and silver owners.
Oh, it certainly has. But here's the bigger question. And this is what I talk about on the Eastman Financial Report, is how do you read these headlines? What do they mean? And what that's telling you, and the question you should ask is, who did they buy the $12 billion from? Did they go out into the market and just pull it out? Did they buy it from the Chinese? Did they buy it from the Japanese? No, they bought it from the banks. And what that story says is when they buy bonds from the banks, of course, they're putting Treasury dollars into the bank, not Federal Reserve dollars. Those are the new ones they print. These are existing reserves at the United States Treasury. They're buying and holding their own debt to pump money into the banks. And the reason they do that is because banks have a liquidity problem. When you go back to COVID and you think about, and this has been a regional bank story for quite a while, when you look at all the empty shopping malls and all the empty office buildings in town, all of those mortgages are local bank obligations. They're assets on the balance sheet of your local bank. They tend to not get syndicated. So what it tells you is because these banks have so many poorly performing loans, that their ratios are getting to the point where the Federal Treasury has to step in and they have to buy and then put cash in. And the question is, why is cash any more or less liquid than federal treasuries? And what are they doing? What do you need cash versus a treasury? A treasury's liquid. The bank can pick up the phone call. Well, not anymore. You contact your broker, or you do it electronically, you sell and you buy. So the question I ask in that story is why? Why are they doing that? And of course, it doesn't tell you in the story. They just tell you the fact that it happened. But the bigger question is, what would prompt the Treasury to take $12 billion, they could build a bridge, to buy bonds from a bank instead? That's spooky. That's spooky.
Yeah, it is. Did you look at the cover of The Economist magazine from a few weeks ago, talking about the issues ahead for 2026, and they have the dollar crashing and the dollars are all falling off the chart? I mean, it sounds like The Economist magazine, which is the big globalist magazine, thinks that we're in for a dollar collapse next year.
Well, this is a serious problem because when I started the Eastman Financial Report in March of 2023, that was 2.5, almost 2.75 years ago, gold was trading at $1,805 an ounce. And when I went back to the reruns in the vault, by the way, if you want to see the reruns, subscribe to the vault. It's a great product.
Thank you.
But the point is, it was $1,805. And my question then was, could gold ever go to $2,000 an ounce? Could it ever happen? Well, today, when I was preparing for the show, it's $4,250 an ounce. It's more than doubled in less than 3 years. That suggests, and of course, the gold coins didn't get bigger. The gold blocks didn't get bigger. It's the same size ounce. It's you need more paper dollars or digital dollars to buy the same ounce of gold. You need more paper dollars to buy an automobile. The average price is $50,000 for a new car. You need 436,000 of these paper dollars to buy a new house. That's the median price of new houses. So when you start to look at commodity prices within the United States economy, what you're seeing is inflation that's way above the 3%. And of course, if you're on Social Security, you get the letter from the Social Security Department saying you get a 2.8% raise. That's the consumer price index, but we all know that the dollar is deteriorating. And when you look at, from a financial perspective, at the United States government with 330 million people and 165 million taxpayers, and we got 38 trillion, now maybe going to 42 trillion in debt, that's unsustainable, and the world knows it. So if you're if you're some country somewhere and you've got a bunch of resources and you want to park your resources in safe international currency, well, it was, 100 years ago, it was the British pound was the gold standard. Well, then it was the US dollar. And now it's gold. You can see more and more people are migrating away from the dollar because there's this concern. How do you have a federal Congress that spends $2 trillion a year that they don't have and keeps borrowing? The debt's getting bigger and bigger. The debt service is taking up more and more tax dollars. And then look at that as a stable investment. And you can't. That's the reason when you say a dollar collapse, what that means is there's no global demand for dollars. Now, back in the 70s, we were cleverly pegging our dollar. We took it off the gold standard and we put it onto the oil standard. Those are the petrodollars. And of course, you knew you could trade dollars for petroleum and your country needed petroleum. It created a very stable dollar. But that isn't the case today. And with the mismanagement in Washington, this flagrant mismanagement of our national resources, people are waking up worldwide. And that's why you have BRICS and you got the Chinese making a big pile of gold and other countries. If you look at the demand for gold by central banks globally, it's exploding because people realize that the dollar's position as the global safe harbor is at risk because of the profligate spending by a Congress. And you look at this, with this kicking the can down the road. They shut the government down on September 30th, which was the last day of the fiscal year. And we had 43 days of foolishness. Then they passed something to kick the can to January 30th. So I'm kidding around with my viewers. I'm saying, you know what? We're going to have the same debate. Food stamps going to be cut off. The poor air traffic controllers. I mean, how do you run your family household budget when you don't know if your paycheck? This is broken in Washington, and because it's broken, that's why the dollar is weak. Because finance doesn't look at your world military things. That's been happening since creation. But what the financial world looks at is the balance sheet and the numbers, and saying, you know what? The United States has more debt and more expenditure than its population can possibly afford. And you're seeing it in fixed assets like gold, silver, and real estate, collectible items. If you're into old collectible cars, man, the prices are through the roof because you'd rather invest in an old Corvette than put it in some bank somewhere. And, you're getting 2% interest when inflation's 12%. This is why we're seeing that.